Welcome, everyone. If you're joining me today, I'm hoping that means you're interested in ESG investing. It can be a polarizing topic, so hopefully you don't hate ESG investing, but it's a topic that we continue to present on each year because it's both professionally and personally a passion for me. As a planner at the center, beyond the Certified Financial Planner designation, I've also studied and passed an exam focusing on ESG investing, which is indicated by those letters behind my name, CSRIC. So although ESG investing has faced, admittedly some headwinds over the last few years, there are trends and regulatory changes coming that suggest that ESG investing is not just a passing fad. So with that said, our agenda today is going to cover the following. First, we'll define ESG investing to better understand all of the factors that can be considered when incorporating ESG into any investment approach. Then we'll discuss some very recent regulatory updates and how they're setting the stage for ESG to evolve over time. We'll then take a deeper dive into ESG investing. We'll look at some strategies and how they can be incorporated into financial analysis of companies and investments. And then lastly, of course, we'll round it out with the center's approach to ESG investing and portfolio construction. So what is ESG? Let's start out with the very, very basics. ESG is an acronym for environmental, social, and governance. And it's an umbrella term. It's used to describe the criteria used to evaluate investments. So these criteria are categorized and they can be incorporated and evaluated throughout the investment process. So I will say that the environmental classification is what people most often think of with ESG investing. And when they hear ESG, and that has probably contributed to some of the headlines surrounding ESG over the last several years, especially as climate change, continues to be hotly debated and reported on. So what's interesting is that E piece, or that environmental factor, is what people most often think of, but there are so many other aspects that can be included with ESG investing. So we have these three guiding factors, but there are many different ways to interpret that framework. I apologize if the words on this screen are hard to decipher, but I wanted to illustrate more or less that there are many elements of ESG investing that can be considered. Looking at the E first, that's what people think of. As you can see with the examples here, however, it is not just climate or carbon emissions focused. That's of course part of it, but there are other aspects considered. One being, the use of natural resources. Are they being managed responsibly and sustainably? How much waste or pollution does the company that's being evaluated create? What is their water usage look like? What does their water usage look like? And again, these are just a few examples of how environmental factors can come into play. Obviously, companies that are focusing on clean energy, clean technology, that would be an obvious E factor company to evaluate. The social classification focuses on the treatment of or consideration of people and relationships. So many people, when they hear the social, they go to that diversity, equity, and inclusion. Again, another recent headline. And again, part of it, just like with climate change, carbon emissions is part of the E, diversity, equity, and inclusion is part of the social piece, but is not all of it. Some really basic examples that can be considered are workplace safety. What do the employee benefits look like? Is this company involved in the community? Does it participate in community development? And it can be even as basic as, hey, is this company in violation of any human rights? Lastly, looking at the governance piece, that orange section, this focuses on the standards and practices of how a company is run. So a few examples we have shown here. What's the executive and CEO comp look like? Is there board diversity? What's the board makeup? Hopefully there's a lack of bribery and corruption and they have protections in place to avoid that. And then also, how does this company handle political lobbying? So speaking of politics, I've said it a lot so far, ESG has been politicized, polarizing over the last few years. And regardless of whether the term ESG is used or not used, there are some regulatory changes that are coming or are already in place that will hopefully help analysts and investors to make more educated choices in the future. And of course, that requires some corporate transparency. So one item that received a lot of criticism last year, that's our first bullet here, was related to the ability for investment managers, specifically those who monitor and manage pension funds, retirement funds, to be allowed to incorporate and consider ESG factors into their investment approach. So this got some pushback, and there were actually some successful congressional efforts to get this overturned. But ultimately, President Biden vetoed the bill that would have nullified this Department of Labor ruling. So it isn't requiring that ESG be considered, but it does allow and protect the ability for ESG to be a considered investment strategy. So not a requirement, allowed to be considered. But our second bullet here, there does appear to be some possible requirements for companies that could be coming into play soon. So the SEC recently passed a ruling called the Enhancement and Standardization of Climate-Related Disclosures for Investors. So a mouthful. But it was a ruling that had been talked about and fought over the last 2 years, honestly, and it was just passed in March of this year. It's already getting pushback and might be, pushed out a little further, which often happens with regulatory changes. But as it stands today, beginning in 2026, publicly traded companies would need to begin reporting their greenhouse gas emissions, any climate-related risks, and information about how they plan to transition to a low-carbon economy. So this is, of course, again, assuming it goes into effect, but a really big shift coming from the SEC to require companies to report these climate-related aspects. One of the headwinds, for ESG investing is that domestically in the United States, we don't really require that reporting. Outside of the US, however, Europe has had regulations and standardized reporting in place for quite some time, again, specifically related to climate-related factors and risks. And it's reported along with their financial statements quarterly. So it makes it much easier, at least again related to the United States, to evaluate a company through that E lens, that environmental lens. And in more recent news, so Europe, requires the reporting, but in more recent news, they're also taking a step, I would say, in the direction of ESG, and they're requiring and regulating companies who provide ESG ratings of other companies. So that's a mouthful, but and it may sound a bit confusing. Basically, there are companies who evaluate other companies, and then they give them an ESG score based on their analysis. And as we talked about on the last slide, there are many, many factors that can be used when looking at a company's ESG strengths, weaknesses, where they can grow. And it's difficult to know what the score is based on and where the company exceeds or has room to improve. Is it the E, the environmental? Is it social or governance factors that are more heavily weighted? Europe is hoping that with this new standardization, it will be easier to understand what those ESG ratings are based on. And I share all of this, to illustrate ESG trends are continuing to move forward. There was a huge run to ESG investments prior to and leading up to 2021. This chart we're looking at is illustrating the quarterly changes in total ESG assets from the beginning of 2021 through the end of 2023. And it's broken out by area. So perhaps not surprisingly, because Europe has had those ESG requirements in place, Europe has the bulk of ESG assets. If you're aware of how markets have performed over the last 3 years, the trend upward, throughout 2021, then back down to mid 2022, likely not a surprise, driven primarily by markets. But what was reported on recently is that, in 2023, there was a huge outflow of ESG assets. Still, market growth, you can see by the end of 2023, ESG portfolios and assets are still at all-time highs. So there may have been, outflows of ESG assets, but it hasn't really knocked down the total that we're seeing today. So, I gave you the framework of the regulatory changes, what is ESG, and now let's talk about some of the history, because I think just in any instance, it's helpful to have a historical understanding of the ESG origins and how ESG is politicized now. I think it might surprise some people that the ESG investment approach actually, dates as far back as the 1700s, and it had very faith-based origins. It was first introduced by the Quakers, and the church essentially restricted how their pupils could do business. They were not allowed to participate in the slave trade. They were not allowed to invest in anything related to alcohol or tobacco. So, of course, ESG has evolved since the 1700s. And there was a period when it started, making some headlines, and it was referred to as SRI investing, or socially responsible investing. And SRI still provides the strategies that we use today, or a good portion of them. But ESG more or less provides the criteria necessary to screen the investments. So I like to look at SRI and ESG as still working together, but ESG has really taken hold as the term we use to describe this type of approach. So, I touched on the Quakers, and the first SRI, or again, comparatively ESG investment funds, date as far back as 1928. And this was an investment called the Pioneer Fund, which again was religiously motivated, and it purposefully excluded investments that were considered sinful. So the exclusionary approach is something that has expanded over time to include different industries that may not align with someone's values or the fund approach or values. An example now, as opposed to being religiously driven, is avoiding fossil fuels, animal cruelty, or the weapon industry. So although this is the original approach, again, it's evolved. It's not the only way ESG investments are reviewed today. There are many different ESG investment screening strategies. And I think this is also, the exclusionary approach has also created some criticisms, because it's reducing that investment universe, and you could have, anytime you're reducing your investment universe, possible performance missed. So again, there's been a large evolution since then, and although someone still may choose to invest due to religious or moral reasons, the investment options are not often as rooted in religious values. And of course, the center, we're taking an agnostic approach. So we want to align with your values and what's important to you, but But with the new ESG lens, it's the idea that I would say more or less companies that are run well, that treat employees well, that are diverse and treat our natural resources with respect, just naming very broad examples, these companies will perform well and can adapt to changes or challenges over time. So overall, making them good investment opportunities. As I mentioned earlier, the environmental aspect of ESG investing is what people think of most often, and it still is a driving force for ESG investment funds. It's another way to allow, again, your moral or value-driven investment portfolio to be rooted in your beliefs. But the pushback again, or criticism, is that you may be reducing your overall investment universe. So an example of that was in 2022. Many ESG portfolios underperformed who had a purposeful exclusionary approach to fossil fuels. In 2022, really the only asset that had positive performance was oil, and the ESG portfolios suffered in that way. So another way to maintain your broad investment universe and avoid that reduction in investment choices is by using this best-in-class approach. This more or less screens companies to see who, as compared to its peers, is doing the best in ESG-related factors. So the hope with this approach is that you maintain all diversification, you can have exposure to all industries, but that during periods of unforeseen changes or stressors, the company will continue to perform well, again, as compared to its peers. So it's really the basic idea that companies who are aware of their risks, they're making changes to improve, again, treat employees well, they're managed well, they will be more resilient in general. So, of course, it's never a good idea, or probably not a good idea, to choose companies and investments based solely on any one ESG factor. Financial matters really are important too, and they matter a lot. So most often with ESG and integration, and often how it's incorporated now, is there's a blend of considering ESG factors and, of course, considering the financial data. So the traditional financial analysis approaches, valuation models, cash flow estimates, they're all completed in the analysis process. It's just blending that qualitative along with the quantitative, and from there, determining the best investment option. And you're incorporating those ESG factors. Oftentimes, not every company is evaluated from the environmental, social, and governance factors. If it scores well in one of those areas, it can be added to the portfolio. And this approach really can complement any actively managed funds analysis process. So, if companies essentially match one another from a financial standpoint, that's when those qualitative ESG factors can more or less determine which company that the fund selects. And just as with best in class, again, a minimal reduction in the investment universe. One of the harsher criticisms or concerns, I would say, that ESG often faces is that performance will suffer. And I mentioned 2022 as an example. ESG integration incorporates the same financial screening factors, traditional financial analysis, and realistically, there are always trade-offs to consider when building any portfolio or choosing any investment strategy. So even when debating, between actively or passively managed portfolio, No approach is going to win every time. But if your ESG portfolio is built with those quantitative and qualitative pieces in mind, the hope is that over the long term, the performance differences, periods of under or overperformance will start to shrink and may not be as drastic again over that long-term period. So, ideally, before jumping into any investment approach, the risks and rewards are understood, and the investor has enough conviction to stick with that strategy for a reasonably long-term period. Long-term investing and sticking to the plan is something that our clients hear all the time. There's always going to be ups and downs, and whether you're investing in an ESG or a traditional portfolio, we will always consider these 3 guiding factors into your portfolio construction. So maintaining diversification, managing risk, and tailoring your portfolio to your unique circumstances should be considered first at all times. These will not take a back seat to those ESG factors. Diversification, that's a core investment philosophy at the center. And we've been able to build an ESG portfolio without negatively impacting our clients' overall diversification. It's an added component to our portfolio construction process. It does not change the foundational layers of that process, again, heavily rooted in these 3 factors. When determining, which mutual funds and ETFs to use in our ESG portfolio, it goes through the same labor-intensive screenings and same process that is used for our traditional portfolio. We're incorporating those quantitative and those qualitative screenings. We make an effort to work with the companies that have a reputation for walking the walk, or they've demonstrated their commitment to their fund values and their fund's investment philosophy. And, an example of that could be they're involved and directly engaged with the companies to improve their behavior. And it can be, as simple as using their shareholding voting power to advocate for better governance. But we like to see how these funds perform over a full market cycle. So that helps us largely eliminate those trendy funds. There are constantly ESG funds coming to market. And if they don't have that kind of investment history that we like to see, that's not included in our approach just yet. We might keep an eye out, but we want to see the performance from the full market cycle. We also meet with the fund managers and company reps. And ultimately, it's based on the numbers and then those qualitative factors, making sure they're sticking to their values. And we review those funds just as regularly as our traditional to complete our due diligence process. So, we've talked a lot about investing today and investment approaches, investment options, but I'm a planner at the Center for Financial Planning. It certainly does not mean that any investment portfolio should exist, especially for our clients, without a financial plan in place first. For individuals, it's so important to incorporate your goals, cash needs, retirement timeline, tax planning, and of course, your comfort with risk in general to determine the overall asset allocation first. So that is still our foundation, financial planning. Asset allocation, I mentioned, more or less, it's the stock to bond ratio suitable for an individual's investment goals. And it's an extremely impactful decision. Some analysis suggests that 40% of investment performance is based on asset allocation. So not necessarily the individual funds you choose, just that general stock to bond mix. Other analysis suggests it could account for as much as 90% of performance. So again, that's over the long term. And I mentioned hopefully shifting or reducing that performance difference over the long term. And we go through this same financial planning process and investment selection process, like I mentioned earlier, for those who are interested or are using our ESG portfolios as those who are invested in the traditional portfolios. So thank you so much, everyone, for joining me today. I hope you're leaving feeling like you understand, why we're still talking about ESG a little bit more, understanding the history of ESG and how it can be incorporated into any portfolio or investment strategy in a mindful way. If you have any questions, please don't hesitate to email me. My email address is on the screen here. And just want to thank you again for your time and hope you have a wonderful day.